Understanding last 12 months, LTM, metrics in financial analysis. Last 12 months, LTM, also known as trailing 12 months, TTM, is a vital financial concept that refers to a distinct time frame, namely, the most recent 12 months leading up to a specific date. This period is instrumental in evaluating a company's performance based on up-to-date data, including revenues, earnings, and other significant financial metrics. Importance of LTM in financial analysis. LTM is particularly beneficial for several reasons. 1. Timeliness. The LTM figures represent the latest available data, which can provide a more accurate snapshot of a company's financial health. In fast-moving markets, data from a full fiscal year may not fully encapsulate recent changes or trends. 2. Seasonality adjustments. Many companies experienced seasonal fluctuations in their business. By analyzing a full 12-month period, analysts can smooth out these variations to better assess ongoing performance trends. 3. Current valuation. When evaluating a company for an acquisition, LTM figures often provide a clearer picture of value than the most recent fiscal year's results. This is especially true for companies undergoing rapid growth or decline. How LTM works. LTM data is calculated by aggregating the company's performance over the most recent 12-month period, starting from the end date of the relevant financial statement. For example, if a financial statement is dated March 31, 2023, the LTM figures would include data from April 1, 2022, to March 31, 2023. It's essential for investors and analysts to recognize that these figures do not align with the company's fiscal year unless the period happens to coincide. Key metrics derived from LTM. Financial metrics derived from LTM data often include revenue, the total income generated by a company during the past 12 months. Earnings per share, EPS, a measure of a company's profitability calculated as net income divided by the number of outstanding shares. Price to earnings, P/E, ratio. This ratio is calculated using the current share price and the EPS derived from the LTM, providing insight into how much investors are willing to pay for every dollar of earnings. Debt to equity, D/E, ratio, a measure of financial leverage. This ratio is calculated by dividing the company's total liabilities by its shareholders' equity, offering insight into the company's risk profile. Comparing companies using LTM. Another major advantage of using LTM figures is their efficacy in comparing companies within the same industry or sector. Investors can assess how different companies stack up against one another by looking at their LTM metrics, thus making informed decisions regarding investments. For instance, when analyzing dividend stocks, the LTM dividend yield can be measured against the most recent SEC yield, helping investors evaluate which security might provide better returns over time. Limitations of LTM analysis. While LTM figures can offer many advantages, they are not without limitations. A one-year period, while comprehensive enough to smooth out seasonal impacts, may not reflect longer-term trends or cycles in volatile industries. Furthermore, companies may experience significant changes in business operations, market conditions, or economic environments that can distort short-term metrics. When making investment decisions, it is often prudent to look at a combination of LTM figures alongside historical data and forward-looking projections. Conclusion. The last 12 months (LTM) concept is an essential practice in financial analysis, aiding investors in obtaining a timely understanding of a company's performance. By evaluating LTM metrics, stakeholders can better gauge operational efficiency, make informed comparisons with peers, and adjust their investment strategies accordingly. Whether assessing profitability, valuations, or equity ratios, LTM serves as a vital tool in the financial analyst's toolkit, driving insights that support sound investment decisions.